Something has shifted in the financial markets, and whether you noticed it or not, the movement in silver over recent weeks represents more than just another commodity rally. For the first time in decades, silver has broken past $93 per ounce, and while that price alone might generate headlines, the forces beneath this surge tell a far more important story about the broader economy, monetary policy, and the choices facing investors today. If you hold silver, you're likely wondering whether this move is sustainable, whether you should be protecting profits, or whether something larger is unfolding. If you don't hold silver, you're probably asking whether you've missed the opportunity, whether this is a speculative bubble, or whether there's still a rational case to consider. Both questions are valid, and both deserve serious answers rooted not in emotion, but in understanding what's actually happening in the global financial system right now. This video is not about hype. It's not about predicting the future or promising easy returns. It's about examining the underlying forces that have pushed silver to levels most analysts considered improbable just months ago, understanding why those forces matter, and thinking through what disciplined investors should be asking themselves in moments like this. Whether you own silver or not, whether you believe in precious metals or remain skeptical, the macroeconomic environment that's driving this surge affects every portfolio, every currency holder, and every person navigating an increasingly uncertain financial landscape. Let's talk honestly about what's changed, what hasn't, and how thoughtful people should be thinking about this moment. Silver didn't reach $93 overnight, and it didn't happen in a vacuum. This move has been building through a combination of monetary conditions, industrial demand dynamics, market positioning, and a slow realization among institutional investors that certain assumptions about metals, inflation, and monetary stability may need to be reconsidered. To understand the significance, you need context. For years, silver traded in a range that felt almost permanent to many observers. It would spike during moments of crisis, then settle back down as confidence returned to traditional markets. It was volatile, yes, but it seemed contained within boundaries that reinforced a common narrative, that precious metals were relics, that modern central banking had moved beyond the need for such anchors, and that real wealth was built in equities, bonds, and innovation. But over the past 18 months, something began to change beneath the surface. Central banks, which had spent years talking about fighting inflation and normalizing monetary policy, found themselves trapped by the size of government debt, the fragility of banking systems, and the political impossibility of sustaining truly restrictive interest rates for long. The promised pivot away from easy money never fully materialized in the way markets anticipated. Instead, liquidity continued to flow, deficits continued to expand, and the purchasing power of major currencies continued to erode in ways that official inflation statistics only partially captured. At the same time, industrial demand for silver began to tighten in ways that surprised even seasoned commodity analysts. The push toward green energy, electric vehicles, and solar infrastructure created structural demand that wasn't cyclical or speculative, but persistent and growing. Silver is not just a monetary metal, it's also one of the most conductive, reflective, and versatile industrial materials on Earth, and the technologies driving the next phase of global infrastructure require it in quantities that existing supply chains are struggling to meet. Add to this a shift in investor psychology. For years, institutional money avoided metals, viewing them as non-productive assets that didn't generate cash flow or dividends. But as confidence in currency stability began to crack, as geopolitical tensions escalated, and as the gap between official narratives and lived economic reality widened, a portion of that institutional capital began quietly repositioning. Not dramatically, not with fanfare, but steadily, methodically, and with the kind of conviction that moves markets over time. The breakout past $93 wasn't caused by any single event. It was the result of multiple forces converging: monetary debasement that refuses to stop, industrial demand that refuses to slow, and a growing recognition among serious investors that holding real assets in an environment of currency instability isn't speculation. It's prudence. When silver makes a dramatic move, the immediate reaction from mainstream financial media is often predictable. It's either dismissed as a speculative frenzy driven by retail traders and internet forums, or it's framed as a bubble that will inevitably collapse, leaving latecomers holding worthless positions. Both narratives miss the point because both ignore the underlying fundamentals that make this moment different from past spikes. Most people think about silver the way they think about stocks or cryptocurrencies, as something you buy hoping the price goes up so you can sell it to someone else at a profit. In that framework, silver is just another speculative vehicle, and every rally is assumed to be temporary. But that framework misses the essential nature of what silver actually is. Silver is money. Not in the sense that you can spend it at a grocery store, but in the deeper sense that it has been recognized as a store of value for thousands of years, across cultures, across political systems, and across monetary regimes. When currencies are stable, when trust in central banks is high, and when debt levels are manageable, the monetary function of silver fades into the background. It becomes primarily an industrial commodity, priced based on supply and demand dynamics in manufacturing. But when currencies become unstable, when central banks lose credibility, and when debt levels spiral beyond any realistic path to repayment, the monetary function of silver reasserts itself. People begin to remember that silver, unlike paper currencies or digital ledger entries, cannot be printed, cannot be debased, and cannot be created out of nothing by governments desperate to fund their obligations. The current surge is being misunderstood because most observers are still operating within the framework of the last decade, when central banks appeared omnipotent, when inflation seemed conquered, and when trust in the system remained largely intact. But that framework is breaking down. Inflation has proven far stickier than promised. Debt has grown far faster than GDP. And the tools central banks once relied on to control markets have become increasingly ineffective or politically unacceptable to deploy. Another reason this move is misunderstood is that people conflate volatility with irrationality. Yes, silver is volatile. Yes, it can swing wildly in short periods, but volatility is not the same as randomness. Silver's price movements, especially over longer time frames, are deeply connected to monetary conditions, real interest rates, currency stability, and investor confidence in the broader financial system. When those fundamentals deteriorate, silver responds. When they stabilize, silver consolidates. The volatility is not a bug. It's a feature of an asset that serves as a real-time barometer of monetary stress. Understanding this move requires stepping outside the conventional narrative and asking deeper questions. Not whether silver is expensive or cheap based on recent history, but whether the monetary conditions that suppressed its price for years are still in place. Not whether this rally looks like past bubbles, but whether the fundamentals driving it are temporary or structural. Not whether you can time the top perfectly, but whether holding real assets during periods of currency debasement makes sense, regardless of short-term price action. History doesn't repeat, but it does echo, and the conditions we're seeing today have recognizable precedents. When governments expand money supplies rapidly, when debt grows faster than the economy, when trust in currency stability erodes, and when alternative stores of value become scarce relative to demand, markets tend to behave in predictable ways. Not with exact timing, not with identical price paths, but with similar patterns that reflect the same underlying human responses to monetary disorder. Look back at the 1970s. Inflation was rising, real interest rates were negative, confidence in the dollar was collapsing, and precious metals surged in a way that seemed irrational at first, then inevitable in hindsight. Silver went from under $2 per ounce in the early part of the decade to nearly $50 by 1980. The move wasn't smooth. It was punctuated by sharp corrections, moments of doubt, and plenty of opportunities for people to convince themselves the rally was over. But the fundamental driver, currency debasement and loss of confidence, remained in place until policy genuinely changed, until interest rates were raised high enough to cause real economic pain, and until inflation was truly broken. That period offers lessons, but it also offers warnings. The peak of the silver market in 1980 was driven not just by fundamentals, but by speculation, leverage, and a market corner attempt that distorted prices beyond any reasonable valuation. When the bubble burst, it collapsed violently, and it took decades for silver to recover. The lesson is not that metals can't go up, but that parabolic moves driven by speculation rather than fundamentals always end badly. The disciplined investors who understood the difference between a monetary crisis and a speculative mania were the ones who preserved wealth. The ones who chased prices blindly were the ones who lost fortunes. Fast forward to the late 2000s and early 2010s. After the financial crisis, central banks flooded the system with liquidity, interest rates collapsed, and trust in the banking system was shaken. Gold and silver both surged, with silver briefly touching nearly $50 again in 2011. Once again, the move was driven by genuine monetary concerns, but the final parabolic phase was driven by speculation. And once again, when sentiment turned, the correction was brutal. Silver spent the next decade consolidating frustrating holders and convincing many that the entire metals thesis was dead. But here's what's different now. The monetary conditions today are not a temporary crisis response that can be easily reversed. The debt levels are higher, the political will to endure the pain of real monetary tightening is weaker, the structural demand from industry is stronger, and the confidence in central banks to navigate this without serious currency consequences is lower. This doesn't mean silver goes up in a straight line. It doesn't mean there won't be corrections or moments of doubt, but it does mean the underlying conditions are more persistent than they were in past cycles. Markets move in waves. They don't rise smoothly and they don't collapse uniformly. In environments like this, the pattern tends to be a series of advances, consolidations, pullbacks that shake out weak hands, and then further advances as the underlying drivers reassert themselves. Patience and emotional discipline matter more than perfect timing. The investors who survive these cycles are the ones who understand that volatility is the price you pay for holding real assets during monetary instability, and that trying to trade every swing usually results in selling at bottoms and buying at tops. History teaches us that when monetary fundamentals are strong, metals languish. When monetary fundamentals deteriorate, metals eventually respond. And when monetary fundamentals are in genuine crisis, metals can move in ways that seem extreme until you understand the context. We're not yet in crisis, but we're no longer in stability. And that shift is what this current move reflects. If you've been holding silver through the years of frustration, through the sideways grind, through the moments when it seemed like the entire thesis was wrong, this move probably feels validating. It should. You endured a long period when conventional wisdom said you were foolish, when opportunity cost seemed high, and when momentum was entirely against you. The fact that silver is now breaking out doesn't make you a genius, but it does confirm that the monetary concerns that led you to hold a real asset were not irrational. That said, validation is not the same as vindication, and this is not the time to become complacent or emotional. The move past $93 changes nothing about the fundamental reasons you held silver in the first place. If you held it as insurance against currency debasement, as a hedge against monetary instability, or as a long-term store of value, those reasons remain valid regardless of whether silver is at $30 or $93 or higher. The price is a reflection of changing market perception, but the underlying insurance function doesn't change. The temptation now is to start thinking about profits, about whether to sell, about whether to take chips off the table. Those are reasonable considerations, but they should be made based on your original thesis, not based on recent price action. Ask yourself, has the monetary environment stabilized? Have central banks credibly restored trust in currency? Have debt levels been brought under control? Have the structural supply-demand imbalances in the physical market been resolved? If the answer to those questions is no, then the fundamental case for holding silver remains intact. At the same time, don't let past frustration turn into future greed. If silver was insurance when you bought it, it's still insurance now. If it represented a certain percentage of your portfolio, designed to protect against specific risks, it should probably still represent a similar allocation, adjusted for changes in valuation and risk. The worst mistake you can make after a long consolidation and a sharp breakout is to abandon the discipline that got you here and start treating silver like a lottery ticket. Consider your time horizon. If you're holding for the long term because you believe the monetary story is multi-year or even multi-decade, then short-term price swings don't matter much. But if your goal was to preserve purchasing power and you now feel genuinely concerned that silver has moved too far too fast, there's nothing wrong with taking partial profits and rebalancing. The key is to act based on rational risk management, not based on euphoria or fear. One thing to watch is the difference between paper price and physical availability. In past rallies, we've seen situations where the price on exchanges rises, but physical metal becomes difficult to acquire at anywhere near that price. Premiums over spot can spike, delivery times can extend, and the market can become dislocated. If you're holding physical metal, that dislocation actually strengthens your position. If you're holding paper proxies like ETFs or futures, understand that you're exposed to counterparty risk and potential divergence between what the contract says and what you can actually claim. Most importantly, stay informed but don't become obsessed. Silver's value to your portfolio is not what it does this week or this month. It's what it does over the full monetary cycle. The move past $93 is a signal that the cycle is progressing, but it's not the end of the story. Discipline, patience, and a clear understanding of why you hold what you hold will serve you far better than trying to trade every swing or optimize every decision. If you've been watching this move from the sidelines, wondering whether you've missed the opportunity, the first thing to understand is that investing based on fear of missing out is almost always a mistake. The price of any asset reflects all available information at the current moment, which means that, by definition, silver at $93 is pricing in everything the market currently knows and expects. The question is not whether silver has already moved, but whether the conditions that drove that move are likely to continue, intensify, or reverse. The second thing to understand is that the decision to hold silver, or any real asset, should not be based on trying to catch a rally. It should be based on a rational assessment of your exposure to monetary risk, your portfolio's sensitivity to currency debasement, and your need for assets that behave differently than stocks and bonds during periods of financial stress. If you have no precious metals exposure at all, and you believe there's even a reasonable probability that currency stability will continue to deteriorate, then having some allocation makes sense regardless of where the price is today. That said, chasing prices after a sharp move is dangerous. If silver has just surged 20 or 30% in a short period, the probability of a pullback or consolidation increases simply because markets don't move in straight lines, and profit-taking is a normal part of any rally. Trying to jump in at the top of a spike often results in buying at exactly the wrong moment, experiencing immediate losses, and then selling in frustration just before the next leg higher begins. If you're considering an initial position, the smart approach is to think in terms of averaging in overtime rather than making a single large purchase. This reduces the risk of entering at a local peak, smooths out volatility, and allows you to build a position based on fundamentals rather than emotion. It's not exciting, it doesn't feel like you're seizing the moment, but it's the approach that tends to work over the long run. Another consideration is understanding what form of silver makes sense for you. Physical coins and bars offer the purest exposure and the most direct ownership, but they come with storage costs, security concerns, and potential liquidity issues. ETFs offer convenience and liquidity, but they introduce counterparty risk and don't provide the same insurance against systemic breakdown. Mining stocks offer leverage to silver prices, but also introduce company-specific risk, management risk, and operational risk. Each option has trade-offs, and the right choice depends on your goals, your risk tolerance, and your time horizon. One mistake people make when entering metals for the first time is treating it like buying stocks. They expect steady appreciation, they expect liquidity, and they expect the market to reward them for being right. Metals don't work that way. They're volatile, they can go sideways for years, and they can test your conviction repeatedly. If you're not prepared for that reality, if you're going to panic during the first correction, then you're better off not entering at all. The question you should be asking is not whether silver will go higher from here, because no one knows, but whether having some exposure to a real asset that historically holds value during monetary instability makes sense for your situation. If you believe central banks will successfully restore sound money, reduce debt, and stabilize currencies without significant loss of purchasing power, then silver probably doesn't fit your worldview. But if you believe the opposite, or even if you're just uncertain, then having some allocation is a rational hedge, not a speculation. Don't rush, don't chase, don't invest money you'll need in the short term, and don't expect silver to solve your financial problems or make you wealthy overnight. Treat it as insurance, treat it as a small portion of a diversified portfolio, and treat it with the same discipline you would any other serious financial decision. To understand why silver is moving now, you have to understand the environment we're in. This is not a normal business cycle. This is not a temporary disruption that will be resolved with a few rate adjustments or fiscal tweaks. What we're experiencing is the late stage of a decades-long debt supercycle, where borrowing has been used to sustain growth, finance government operations, and maintain standards of living beyond what organic economic activity could support. The mathematics of this situation are straightforward, even if the politics and psychology are complex. When debt grows faster than GDP for long enough, eventually you reach a point where servicing that debt consumes an unsustainable portion of revenue. At that point, governments face a choice: default explicitly, which is politically catastrophic, or default implicitly through inflation, which is politically easier but economically devastating for savers and anyone holding the currency. Every indication suggests that major governments are choosing the second path. Interest rates have been raised rhetorically, but not enough to genuinely slow debt accumulation or break inflation expectations. Fiscal deficits remain enormous despite supposedly strong economies. Central bank balance sheets have contracted modestly but remain historically bloated. And the political appetite for the kind of austerity or genuine monetary discipline that would restore sound money is essentially non-existent. This matters for silver because silver is, at its core, an anti-debasement asset. When currencies are being debased slowly and quietly through persistent inflation and monetary expansion, assets that can't be printed become more valuable over time in nominal terms, simply because the currency in which they're priced is worth less. This isn't a prediction, it's arithmetic. If the supply of dollars increases faster than the supply of silver, and if demand for both remains constant, then the dollar price of silver must rise. But there's another layer. Inflation is not just a monetary phenomenon, it's also a psychological one. People's willingness to hold a currency depends on their confidence that it will maintain purchasing power. When that confidence erodes, when people begin to expect ongoing debasement, behavior changes. They move out of cash and bonds and into real assets. They demand higher interest rates to compensate for inflation risk. They reduce their savings rate and increase their consumption today, rather than risk holding devalued currency tomorrow. We're beginning to see early signs of that shift. Not hyperinflation, not panic, but a quiet loss of confidence in the idea that central banks have everything under control. Bond yields remain elevated despite rate cuts. Consumers are pulling back despite low unemployment. And alternative stores of value, from real estate to commodities to precious metals, are attracting flows that weren't there a few years ago. The industrial side of the silver story also ties into this broader macroeconomic shift. The push toward electrification, renewable energy, and technological infrastructure is not a passing trend. It's a structural transformation driven by political mandates, environmental concerns, and energy security needs. Silver is embedded in that transformation in ways that are difficult to substitute. Solar panels, electric vehicle components, advanced electronics, and grid infrastructure all require significant silver inputs. As those industries scale, demand scales with them. At the same time, silver supply is constrained. Most silver is produced as a byproduct of other mining operations, which means supply doesn't respond quickly to price signals. New mines take years to develop. Existing operations are facing higher costs, regulatory pressures, and resource depletion. And recycling, while helpful, can't keep pace with demand growth. The result is a market that's structurally tighter than it's been in decades. This is the environment we're in. Monetary instability that can't be easily resolved, fiscal trajectories that can't be easily corrected, industrial demand that's persistent and growing, and a supply base that's struggling to keep up. Silver's move past $93 is not an accident. It's a reflection of these realities finally being priced into the market. In moments like this, when prices are moving sharply and headlines are multiplying, the temptation to act impulsively is strong. But impulsive decisions, driven by emotion rather than analysis, are almost always the wrong decisions. So before we talk about what you might consider doing, let's be very clear about what you should absolutely avoid. First, do not react emotionally to daily price swings. Silver can move 5 or 10% in a single session. It can drop sharply on no news, then recover just as quickly. If you're checking the price every hour, if you're feeling anxiety with every dip or euphoria with every spike, you're setting yourself up to make poor decisions. The price today or tomorrow tells you almost nothing about the price in 6 months or a year. Letting short-term volatility dictate long-term strategy is a recipe for buying high and selling low. Second, do not chase prices blindly. Just because silver went up yesterday doesn't mean it will go up again today. Just because it broke past 93 doesn't mean 95 is guaranteed, or that 100 is inevitable. Markets move in waves, and the strongest rallies are often followed by the sharpest corrections. If you're buying only because the price is rising, you're speculating on momentum, not investing based on fundamentals. And when momentum breaks, you'll be left holding a position you don't understand and don't have conviction in. Third, do not use leverage or borrow money to buy silver. The temptation to amplify returns with margin or options is understandable, but leverage is a double-edged sword. Yes, it magnifies gains when you're right, but it also magnifies losses when you're wrong. And in a volatile asset like silver, being temporarily wrong can wipe you out, even if your long-term thesis is correct. There are countless stories of people who were right about the direction, but wrong about the timing, and who lost everything because they used leverage. Don't be one of them. Fourth, do not follow online hype or social media influencers blindly. The internet is full of people making bold predictions, calling for silver to hit $200 or $300 or $1,000. Some of them may believe what they're saying. Others are trying to drive traffic or sell products. Either way, their incentives are not aligned with yours. Your financial security is your responsibility, not theirs. If you make decisions based on someone else's conviction rather than your own understanding, you'll never know when to hold and when to fold, and you'll be at the mercy of narratives that can shift overnight. Fifth, do not ignore your overall portfolio allocation and risk management. If silver represents 5% of your portfolio and it doubles, it now represents a much larger percentage. That might be fine, or it might mean you're overexposed to a single asset class. Rebalancing doesn't mean you don't believe in the thesis anymore. It means you're managing risk prudently. Letting winners run forever sounds great in theory, but in practice, concentration risk can turn a good position into a catastrophic one if the market turns against you. Sixth, do not assume that price increases are permanent or one-directional. Every asset goes through cycles. Metals are no exception. The fact that silver has surged doesn't mean it can't pull back, consolidate for months, or even correct sharply before moving higher again. If you're not mentally and financially prepared for volatility, if a 20 or 30% drawdown would cause you to panic and sell, then you shouldn't be in the position in the first place. Seventh, do not neglect the difference between paper and physical. If you're holding silver through an ETF or a futures contract, understand that you don't own metal, you own a claim on metal. In a systemic crisis, those claims may not perform the way you expect. Counterparty risk is real. If the reason you hold silver is as insurance against systemic breakdown, then holding it in a form that depends on the system functioning properly defeats the purpose. Finally, do not forget that uncertainty is the only certainty. No one knows what will happen next. Not the analysts, not the economists, not the central bankers, and certainly not the people making confident predictions on the internet. The best you can do is understand probabilities, manage risks, and maintain discipline. The worst you can do is pretend you have certainty when you don't, and make irrevocable decisions based on that false confidence. One of the hardest things to navigate in markets is the gap between what's actually happening and the stories we tell ourselves about what's happening. Human beings are narrative creatures. We don't just see prices moving, we construct explanations for why they're moving, and those explanations shape our expectations about what will happen next. The problem is that narratives can be seductive, convincing, and completely wrong. Right now, there are multiple narratives circulating about silver. One narrative says this is the beginning of a historic bull market that will take silver to levels we haven't seen since the early 1980s. Another narrative says this is a speculative bubble being driven by retail traders and social media hype, destined to collapse just like it did in 2011. A third narrative says silver is responding rationally to deteriorating monetary fundamentals and will continue to rise as long as those fundamentals persist. Each narrative sounds plausible, each has proponents who can cite data and historical precedents, and each will influence how people position themselves and react to future price action. The trap is believing that one of these narratives is definitively true and the others are definitively false. Markets are complex systems influenced by countless variables, many of which are impossible to quantify. The narrative that feels most compelling to you may reflect your biases more than it reflects reality. The narrative that seems most ridiculous may turn out to be correct. And the narrative that's actually driving prices may be one that no one has even articulated yet. Disciplined investors understand this. They don't reject narratives entirely, because narratives help organize information and guide thinking. But they hold narratives loosely, updating them as new information arrives, and always maintaining a healthy skepticism about their own certainty. They ask not just whether a narrative makes sense, but what evidence would prove it wrong, what alternative explanations exist, and what their plan is if the narrative breaks down. Psychology also plays a role in how people react to volatility. When silver is rising, the natural emotional response is excitement, validation, and a desire to increase exposure. When silver is falling, the natural response is fear, doubt, and a desire to cut losses. Both responses are understandable, and both are usually wrong. The time to be cautious is often when you feel most confident, and the time to be interested is often when you feel most pessimistic. This is why having a plan matters so much. Not a plan in the sense of, I'll sell when silver hits $100, but because that's just a price target, not a plan. But a plan in the sense of understanding why you hold, what conditions would make you increase or decrease exposure, and how you'll manage your emotions when markets inevitably move against you. Without that kind of plan, you're reacting to narratives and emotions rather than executing a strategy. Another psychological trap is recency bias. Because silver has been rising lately, it feels like it will keep rising. Because it frustrated holders for years before that, there's also a voice in your head saying it will collapse again. Both feelings are based on extrapolating recent experience into the future, and both are unreliable guides. What happened over the past few weeks or months tells you almost nothing about what will happen over the next few weeks or months. The only thing that matters is the underlying fundamentals and how those fundamentals are likely to evolve. The hardest psychological skill in investing is maintaining conviction without becoming rigid. You need to believe in your thesis enough to withstand volatility and criticism, but you also need to be flexible enough to change your mind when the facts change. That balance is difficult, and most people tilt too far in one direction or the other. They either abandon their thesis at the first sign of trouble, or they hold it so tightly that they ignore clear evidence that the world has changed. If there's one thing to remember about psychology and narratives, it's this. Your emotions are not your guide, and the prevailing narrative is not your oracle. Your guide is your understanding of fundamentals, your discipline in managing risk, and your willingness to remain humble in the face of uncertainty. Everything else is noise. Disciplined investors think in decades, not days. They understand that wealth is built not by perfectly timing markets, but by positioning intelligently, managing risk prudently, and allowing time and compounding to do their work. In the context of silver and precious metals, this means understanding that the current move, as dramatic as it feels, is just one chapter in a much longer story about money, value, and the relationship between governments and the currencies they issue. The long view recognizes that monetary systems are not permanent. The current fiat system, where currencies are backed by nothing but government promises and central bank credibility, is historically unusual. For most of human history, money was tied to something real, whether gold, silver, or other commodities. The experiment with purely fiat money is only about 50 years old, dating back to the early 1970s when the last ties to gold were severed. In historical terms, that's an eye blink. This doesn't mean the fiat system will collapse tomorrow or even in our lifetimes. It means that the system is inherently fragile, dependent on trust, and vulnerable to the very human temptation to solve problems by printing money rather than making hard choices. Over time, that temptation has proven irresistible. Every fiat currency in history has eventually lost most or all of its value. Not because of conspiracy, but because of incentives, because of politics, and because of the mathematical impossibility of sustaining debt growth faster than economic growth indefinitely. Disciplined investors holding real assets like silver understand this historical context. They're not betting on a collapse next month. They're acknowledging that over long periods, the probability of currency debasement is high, and that holding assets, which can't be printed, is a rational response to that probability. They're not trying to get rich quick. They're trying to preserve purchasing power across generations. The long view also means accepting that there will be periods of frustration. There will be years when holding silver feels like a mistake, when it underperforms stocks or real estate or bonds, when everyone tells you that you're fighting the last war and that modern monetary policy has made metals irrelevant. Those periods test conviction. They separate people who understand why they hold what they hold from people who are just following trends. But the long view also means recognizing when conditions change. When debt levels reach extremes, when central banks lose credibility, when inflation becomes persistent rather than transitory, when geopolitical stability fractures, the calculus shifts. Metals move from being a fringe insurance policy to being a mainstream risk management tool. And the people who maintain positions through the lean years are the ones positioned to benefit when the cycle turns. What disciplined investors know and what they try to remember even when markets make them question everything is that no asset goes up forever, no strategy works in all environments, and humility is a prerequisite for long-term success. They know that silver at $93 might be cheap or expensive depending on what happens over the next 5 or 10 years. They know that past performance, whether in metals or stocks or anything else, tells you almost nothing about future returns. And they know that the goal is not to maximize returns, but to survive, to preserve capital, and to position for a range of possible futures, rather than betting everything on one outcome. The long view is not passive. It doesn't mean buying and forgetting. It means staying informed, adjusting as conditions change, and maintaining the discipline to stick with sound principles even when they're unpopular. It means recognizing that the market can remain irrational longer than you can remain solvent, which is why leverage and concentrated bets are so dangerous. It means understanding that in investing, as in life, the tortoise usually beats the hare. Silver's move past $93 is significant, but it's not the end of the story. It's a signal that something has shifted in how markets are pricing monetary risk, industrial demand, and the long-term sustainability of current policy paths. Whether this move continues, consolidates, or reverses in the short term is unknowable. What matters more is that the underlying conditions driving this move are not temporary anomalies, but structural features of the current economic environment. If you hold silver, this moment should reinforce the importance of discipline, patience, and clear thinking. It's not a time to become greedy or complacent. It's a time to reassess your allocation, ensure you still understand why you hold what you hold, and prepare mentally for the volatility that inevitably accompanies any significant market move. Your goal is not to perfectly time the top, but to maintain a position that makes sense for your situation and your risk tolerance through whatever comes next. If you don't hold silver, this moment should prompt you to think seriously about your exposure to monetary risk and whether your portfolio is positioned for a range of possible futures. That doesn't mean rushing to buy metals at any price. It means educating yourself, understanding the trade-offs, and making decisions based on analysis rather than emotion or fear of missing out. There is no perfect entry point. There's only informed positioning based on fundamentals and risk management. For everyone, regardless of where you stand, the most important lesson from this moment is that markets are not static, conditions change, and assumptions that felt ironclad can break down faster than anyone expects. The discipline to stay informed, to think critically about narratives, to manage risk prudently, and to avoid the emotional extremes of greed and fear will serve you far better than any prediction about where prices are headed next. Silver has surged. The forces behind that surge are real. The implications extend beyond precious metals to the broader questions of currency stability, debt sustainability, and the choices facing investors in an uncertain world. Whether you participate in this market or not, understanding what's driving it makes you a better, more informed steward of your financial future. Stay thoughtful, stay disciplined, and remember that in markets, as in life, understanding the game matters more than predicting the next move.